Good evening, student. Last class, last class we discussed about the Keynesian model, and in the Keynesian model, we discussed about the marginal propensity to consume, MPC, MPS, and the consumption function. We derived aggregate demand, then investment multiplier. Today, we just discuss about the extension of this Keynesian model. In this model, here, last two classes, we just discussed about the closed economy, where only household and farm sector present. But today, we discussed about the open economy, where government sector also present. In this Keynesian model, we extend two sector model to three sector model. And there are three economic agents: household, farms, and government. And because of that, the aggregate demand is the addition of this concept C plus I plus G. C is the consumption which is goes coming from households, I is the investment which coming from the funds, and G is the government expenditure. Once we introduce the government sector, certain changes are needed to be carried out in the Keynesian model. Government has the power of earning economy, earning by revenue by imposing taxes. Government also spends money for the welfare of people. Sometimes government needs to borrow when its revenue are less than expenditure. Such a situation is called budget deficit. In case where the revenue is less than the expenditure, and government always spend its money always in the welfare works. Because of that, government face the budget deficit. And at the time when revenue exceeds government expenditure, it is a situation of surplus budget. Government exercise fiscal policy or varying the tax rate or changing the level of government expenditure. The objective of government intervention is to smoothen the operation of the economy. So, government is also an important sector for the economy to carry the economic progress of a country. The government sector. Government affects the equilibrium level of income and output as it purchases goods and services. Hence, government purchases G is an important component of the aggregate demand. So, in aggregate demand, AD equal to C plus I plus G, where I dash is a planned or autonomous investment which is dependent of income. In other words, we assume that investment is fixed or constant. As government sector collects tax from individuals, there may be certain changes in the consumption function. Because of that, the households or individuals, certain amount is going as taxes which imposed by the government. So that C equal to C dash plus CY. Consumption is depend upon disposable income, YD, instead of total income. Because in case of the total income, some amount is going to the government from as taxation. So YD equal to Y minus TA, where Y is the aggregate income and TA is the tax. Another component which finds its way in the disposable income is government transfers, such as subsidies, pensions, scholarship, etc. These are an addition to the individual's income, but there is no corresponding output. So, YD equal to disposable income equal to Y minus TA plus TR. Y is the income, TA is the tax, and TR is the government transfers. In place of the YD, if you put AD, then you find that AD equal to C dash plus C, YD plus I dash plus G. And again, if you put, in case of the YD, we put the C dash plus C, Y minus TA plus TR plus I dash plus G. Then we find that government expenditure is fixed at G days. Also, government makes a constant amount of transfer TR. Government collects a fraction income TY H tax. And besides these equations, when we total find that C dash plus T CTR plus C Y to Y. It is important to note that transfers TR are increasing the consumption spending CTR. That means marginal propensity to consume times the amount transfers. On the other hand, income tax lowers the consumption spending of each level. This is because taxes affect disposable income and not the total income. So, the marginal propensity to consume out of disposable income remains C, but marginal propensity to consume out of income is C bracket 1 minus T multiplied into C, where I minus T is a function of income after deduction of taxes. So that for that, we know that income and output levels get affected with the introduction of the government sector. And we will see the change algebraically as well as with the help of a diagram. And the diagram is described on this page. We can describe the diagram. In the diagram, we present two eddy curves. AD1 shows absence of government sector and AD2 in the presence of government sector. Thus, AD2 includes taxes and transfers. We observe that AD2 is flatter than AD1 and has a higher y-intercept than AD1. It is because the slope of AD2 is y minus t into c instead of c. That means it is derived from it is the function of income after deduction of tax. The vertical interception includes in this diagram. AD1 is the without government sector, AD2 is with government sector. So that A1 dash equal to C1 C dash plus I dash and A2 dash equal to C1 C dash plus I dash plus CTR dash plus G dash. Here in the second A2 the government sector is present. And another diagram, we saw the effect of government sector's presence on equilibrium levels of income and output. There is two cases when the government sector is not present and when government sector is present. When government sector is not present, the equilibrium takes place at point E1, where the 45-degree line intersects at E1. When this intersection gives us Y1 equilibrium output, and now H government spending G dash and other components like taxes transfers come into existence. AD1 equal becomes factor and changes its y-intercept also. The new curve is labeled as AD2. The second Keynesian cross happens at the point E2. Now the equilibrium gives us the equilibrium output as Y2, and Y2 is greater than Y1, and we can say that introduction of the government sector increases the level of income and output in the economy. Government spending and the multiplier. Like the two-sector model, like in the multiplier, the government in three-sector model also where government is present, the multiplier is different from the two-sector. Then the multiplier is introduced in government sector is delta y by delta a dash equal to 1 by 1 minus C plus CT, or 1 by 1 minus Y2 into C. As seen in the previous unit, in the absence of the government sector, the multiplier is only 1 by 1 minus C. But in the presence of government sector, the government purchases of goods and services make a substantial difference in the economy. The value of the multiplier is reduced, and the government multiplier is alpha G. And we can say that alpha G and alpha G always more than the alpha G is less than the two sector, less than the alpha. Thus we observe that the value of the multiplier gets reduced in the presence of the government sector. Then automatic stabilizer. Automatic stabilizer are the revenue and expenditure items in the government budget, which automatically change with the state of the economy in such a way as to stabilize GDP. We found that imposition of income tax lowers the value of the multiplier alpha. Then it reduces the value of the multiplier because the increase in consumption out of changes in income gets reduced due to imposition of taxes. When such stabilizers are in place, the change in autonomous expenditure means I will have smaller effect on output. Presence of such stabilizers reduce the volatility in the economy, particularly during various phases of business cycle. When the economy passing through the expansion phase of a business cycle and income is increasing, imposition of progressive taxes on income increases, government revenue automatically and consumption is reduced. So when the economy is passing through the recession phase, tax burden is automatically reduced because of reduced income. This stabilizer act as shock absorbs to the economy. So automatic stabilizer has also plays important role in case of the government sector. Then the changes in fiscal policy. Fiscal policy tools are government spending, transfer and tax rate. Government changes the magnitude of these tools as per the situation of the economy. As per the situation, the government can change its fiscal policies. Let us consider that the diagrammatically representation of fiscal policy initiative. Initial level of equilibrium output is Y0. In this figure, we see it Y0. Autonomous spending. G changes. Hence, A0 shift up to A1 days, and AD0 shifts parallel upwards to AD1. As per the equilibrium condition, the equilibrium income and output becomes Y1 from Y0. So, change in autonomous government spending is equal to the change in AD. That means delta Y0 equal to delta G dash plus G C I minus T delta Y0. We have assumed that C dash, TR and Y are constants. Thus, the change in equilibrium income is delta Y0 equal to 1 by 1 minus C into 1 plus T into delta G dash, or otherwise alpha G into delta G dash. The other tool of fiscal policy is income tax. Income tax is generally reduced. Individuals get higher in disposable income. So the effects of reduction in income tax rate, it means that there is a decrease in T, which in turn increases the slope of the eddy curve. initial equilibrium income is Y0, which is intersection between AD0 and the 45-degree line. As AD0 shifts out to AD1, the new equilibrium occurs at E1, which gives us the new equilibrium level of output as Y1. As income tax rate decreases, the equilibrium income and output increases. To find out the change in equilibrium income, we need to equate the change in income to the change in AD. There are two components of change in AD. The first, change in spending at the initial level of income due to reduction in the tax rate. Second, change in spending due to higher income. So these two factors affect the change in AD. Because of that, AD0 change to AD1. This can be saw in the diagram. By combining the two components, we can find that where T dash is the new tax rate and Y0 equal to Y1 by 1 minus C plus CT into A dash. So, delta Y0 by delta T equal to minus C by 1 minus C plus CT whole square into A dash. And equationally, then when we find that, I1 minus CY0 minus CY0 equal to I1 minus C plus CT is the income tax multiplier, which is normally denoted by alpha 1. Similarly, the effect from transfer payment can be written as delta Y0 equal to C by 1 minus C plus CT into delta TR, where CTR is separately written as delta A, comprising of other autonomous spending. A reduction in transfer would lower the equilibrium output, and a rise in the transfers will shift the eddy curve parallel upwards, and a fall in the transfers will shift the eddy curve parallel downwards. Then government budget. Budget is a term which is very important for every individual. The households are interested in knowing how much of income they will receive and what is their expenditure for a given time. So, in case of the individual or households, they interested first they derive income, then expenditure. But the government needs to find out its sources of revenues and areas where it needs to spend. The government budget is of great importance. We will use the term budget to represent government budget. Budget is a record of revenues and expenditure. If government is experiencing a budget deficit, it means government is spending more than earning. In case it face a budget surplus, then the government spending is less than revenue. Generally, budget deficit is faced by majority of the governments in the country. Budget surplus equal to TA dash minus G dash minus TR dash. TA equal to transfer tax. TA tax equal to TY minus G dash minus TR. TR is the transfer, G is the government expenditure. It is common knowledge that when income level is low, the revenue also becomes low, which lead to budget deficit. Then the sum of G dash and TR dash exceeds TY when income levels are low. So, in case of that, when spending is more, that time deficit budget is faced by the government. The income level Y0 shows no deficit and no surplus. In this diagram, we can see it. You can see it there, Y0. Y0 means no deficit, no surplus. On the left of Y0, government runs in deficit, and on the right of the Y0, there is surplus exists. This is because at high income level, the government tax receipt large. If the income does not increase due to fiscal policy tools, government deficit can still decrease. An increase in the investment will lead to an increase in Y, which means raises the tax receipts, and that is how the budget deficit decreases. It follows that during the time of recession, budget deficits are observed. Impact of budget, taxation, and government spending. That an increase in the government spending would decrease the budget surplus. However, it does not hold true always, because increased government government spending has a multiplier effect on the equilibrium level of income and output. This led to higher tax receipts. There is a possibility that the negative effect of such rising government spending is compensated by the positive effect of rising tax receipts, which does not reduce the budget surplus. Algebraically, how the increased government spending reduce the budget surplus can be shown. Delta Y0 equal to alpha G into delta G due to higher government spending. Due to change in income, tax revenue also change. Delta TA equal to T into delta Y0 or T into alpha G into delta G. Change in the budget surplus will be delta BS equal to delta TA minus delta G dash. In this equation, from this equation, we find that T equal T by 1 minus C plus Ct minus 1 into delta G dash. So 1 rupee, we can consider it through a example. Suppose where C is equal to 0.8, T equal to 0.25, delta G 1 rupee. Then delta BS equal to, put the formula, you find that we can solve it through the formula. If the government raises the tax rate and government purchases by the same amount, then what will be the impact on the budget surplus? The response will include the explanation of a concept called balanced budget multiplier. The equilibrium budget will be unchanged as the multiplier will be equal to 1. The equilibrium income can be affected by due to change in the autonomous expenditure, which includes the autonomous investment, autonomous government spending, and government transfers and tax policy or tax rate. To evaluate the impact of change in government spending, we need to assume that only one component of the autonomous spending changes, that is the government expenditure. Hence, like investment multiplier, the government expenditure multiplier also alpha G equal to 1 by 1 minus C, and or delta Y0 equal to 1 by 1 minus C into alpha delta G dash. So, in case of the amount of increase in government spending, the balance budget multiplier is always 1. In this section, we discuss about the government sector, which is very important for the Keynesian model. Before that, in two sector model, we just know about the household and farm, but in the three sector model, government also present, which plays very important role in the economy, and government spending can increase the government economy, country's economic growth also. And there is also automatic stabilizer, which is the economy, which present in the economy, and the government multiplier. And The concept of government budget also important for the country to know about the country's situation. Then external sector. Here we find in previous classes we find that there is important differences between classical economic system and Keynesian economic systems. In this framework, there are two economic agents, the farm and the household sector. The farm carry out production. For production of goods and services, the firms undertake investment in capital goods. The household sector provides labor input to the firms and receive produce by the firms. Thus, the circular flow of income and output takes place. The aggregate demand in the Keynesian system thus includes consumption and investment. As you know, demand plays a dominant role in the Keynesian system. Also, demand creates its own supply. If there is unemployment in the economy, thus whatever is demanded, aggregate demand gets supplied by aggregate supply. The equality between aggregate demand and aggregate supply determines the equilibrium level of output in the Keynesian system. The 45-degree line, the Keynesian cross diagram, ensures that there is equality between aggregate demand and aggregate supply. There is two important issues in Keynesian model. First, an increase in aggregate demand leads to an increase in equilibrium output level. Such increase in demand could be through any of the economic agents, for example, households, farms, and government, and a decrease in aggregate demand leads to a fall in the equilibrium output level. Second, the value of MPC leads to a higher level of equilibrium output due to the multiplier effect. Similarly, a lower value of MPC implies a lower level of equilibrium output. We discuss about consumption function, multiplier, investment multiplier. Now we discuss about external sector. It otherwise known as the rest of the world. Then types of flows in an open economy. During last classes, we assumed that the economy is a closed one. That means the country does not have external trade with other countries. Thus, there are no exports and imports of goods and services. Such an assumption in the present situation is highly unrealistic. Countries do trade with one another. We call it open economy. In an open economy, the domestic economic agents, household, farms, and government interact with the rest of the world or the external sector. Goods and services sold to the external sector are called exports. Goods and services purchased from the rest of the world are called imports. When we subtract imports from exports, we obtain net exports or balance of trade. Thus, Nx equal to x minus n. Nx is positive when export more than imports, and Nx is negative or net export is negative when imports more than exports. Then GDP and GNP. What are the difference? There is difference between GDP and GNP. GDP refers to aggregate output produced by domestic residents and foreign nationals within the geographical boundaries of the country. GNP is defined as aggregate income of citizens of the country. Suppose a citizen of India is working in the US. Whatever he earns is a part of the GNP of India. Suppose a German citizen is working in a farm in India. His income is part of GDP of India because it is not earned by Indian citizen. There could be many other factors that could be traded among countries. The returns to these factors of production are part of the GNP of the country to which they originally belong to. The term net factor income from abroad, NFIA. NFIA, income earned by domestic factors of production in foreign country minus income earned by foreign factors of production in the domestic economy. So that otherwise, GNP equal to GDP plus NFIA. We should note that NFIA can be either positive or negative. The difference between GDP and GNP can be quite large. GDP may exceed GNP in countries where most production units are owned by foreign multinationals or which have a sizable migrant population employed abroad. In India, NFIA has been positive for many years. It was about 4.5% of GDP in 2019. So here in the GNP, GDP and the net factor income from abroad can be added, but so that GNP is more than GDP. Then balance of trade. The types of flows among countries are described in the last classes. Circular flow of income and expenditure. Exports bring money into the country in the form of receipts from exports. On the other hand, imports cause outflow of money from the country in the form of payments towards imports. This exists a balance of trade if exports and imports are equally. Generally, exports are not equal to imports. Trade surplus occurs if the value of exports exceeds the value of imports. On the other hand, if the value of exports is less than the value of imports, then trade deficit arises. Whenever we refer to exports and imports are visualized about external trade in goods as these are visible. But in case of invisibles, in addition to trade in countries trade in services such as consultancy, tourism, shipping, etc. Further, there is a migration of labor from one country to another. A large number of Indians work in foreign countries. Similarly, many foreign citizens work in India. Indian citizens working abroad often send or remit money to their family members in India. These are unilateral transfers, accounted separately under the heading remittances. The payment towards trading in services, the remittances by migrant workers are often termed as invisibles. Invisible constitute a major part of India's trade balance. Surplus in invisibles has helped India in closing trade deficits. So, in case of closing the trade deficit, invisibles are plays important role. Then current and capital account. There are two elements of the balance of payment account: current account and capital account. The current account records the flow of income from one country to another. The capital account records the flow of capital and finance from one country to another. The balance of trade and the balance of invisibles, like the balance of services as it is called at times, together form the current account. Current account means the balance of trade plus the balance of invisibles. This could be a deficit or a surplus in the current account. Thus, current account balance minus balance of trade plus invisibles. The capital account of the balance of payment included transaction involving cross-border purchase of sale of real and financial assets. The assets, that means physical assets such as land, factories, houses, etc., or financial assets such as stocks and bonds. You should note that each transaction is recorded twice in the capital account, once as a credit and again as debit entry, thereby capturing the two aspects of each transaction. For example, purchase of a foreign financial asset such as foreign government bonds or shares of a foreign firm by a domestic resident involves an asset import and a capital outflow. Suppose the value of imports by India exceeds the value of export by India. Thus, the net exports are a negative for India. In order to pay for its extra imports, India has to borrow from foreign countries. It implies foreign currency in coming to India in account. Therefore, such borrowings of foreign currency are shown as credit in the capital account. When interest is paid to the lender country on such debt on a yearly basis, there is an outflow of capital from India. Such servicing of debt is recorded as debit item in the current account of India. When capital moves out of the country, it is shown as debit. However, the investment made in Nigeria, for example, the investment made in Nigeria by Airtel will provide returns to Airtel on a yearly basis. That return will be counted as income for Airtel and it will be shown as a credit in the current account. There are several heads in the capital account: external assistance, external commercial borrowing, short-term credit, banking capital, foreign investment, and other flows. The flows under each of the above heads are in both the direction. For example, if you consider the capital account of India, foreign investment in both direction, there are many foreign multinational companies interest which invest in India. At the same time, there are many Indian multinational companies which invest in foreign countries. Thus, we consider the net amount under each of the above heads. There are time lags involved in the international transaction. For example, data on exports is collected from country at the time goods are shipped, whereas payments for the same way may be received 6 months later, hence may not be recorded in the balance of payment of that year. Therefore, in order to balance the balance of payment account, an entry for error submission is included. So, errors and omission are also so many important element in the balance of payment. When capital inflows exceeds capital outflows, the country has a capital account surplus. In the opposite case, when outflows exceeds inflows, it has a capital account deficit. Then balance of payments. When we combine the current account and the capital account, we obtain the balance of payment. In the table, we present the balance of payment of India for the year 2018-2019. We should notice that trade deficit for India is 1,80,283 million during 2018-19. Net invisibles during that period, however, positive. And at the end, the positive, and that is 12,30,026 million dollar. When we add up these two, we obtain the current account deficit for India, which stands up 56,257 million dollar. The capital account of India for the year 2018-19 shows a surplus of $54,403 million. There is some error and omissions in the accounting process, which is to the tune of 486 million dollars. When we add up the current account and the capital account, we obtain overall balance of 3,339 million dollars, which is negative. The results in an increase in the foreign exchange reserve of India to the take of 3,300 and $339 million. We should note that the balance of payment always balance since it is an accounting identity. Overall, balance of payment balance is obtained by adding the current and capital account balances. A country records a balance of payment surplus. In some cases, there is a current account surplus as well as capital account surplus. There is a current account deficit, but a capital account is larger in magnitude. Third, there is a current account surplus and a relatively smaller capital account deficit. There would be a balance of payment deficit either when there is a deficit on both current and a capital accounts when there is relatively large deficit in either one of the current or capital accounts. Apart from transactions made by private and government agents, the capital account of the balance of payment also includes official reserves transaction that involve change in the stock of foreign exchange reserves held by central bank. So when we face the transactions made by private and government agents, the capital account of the balance payment also includes official reserves, which is held by central bank. When there is a balance of payment surplus, the country experiences net inflow of foreign exchange reserves. In case of balance of payment deficit, there is a net outflow foreign exchange and a corresponding reduction in foreign exchange reserves. So, in case of the foreign balance of deficit, there is net in outflow of foreign exchange, and in case of the balance of payment surplus, the country has net inflow of foreign exchange reserves. Current account balance plus capital account balance plus change in foreign exchange reserve equal to 0. There are certain advantages of an open economy. As goods can be imported, an open economy allows its citizens to consume a variety of goods, even though these are not produced in the country. Secondly, inputs such as raw materials, capital goods, and technology can be imported, which enhance production in the country. Thirdly, the country can export its goods and services, thereby an expansion of market and increases in aggregate demand take place. There are certain demerits of an open economy. So each and everything has two sides, merit side and demerit side. In case of balance of payments merits, as goods can be imported in the import in the importance of the import case, there is some merits and also some demerits of an economy. It is exposed to economic risks such as business cycle in other economy. The demerit open economy has first demerit is the country is independent on other economies. It is exposed to economic risks such as business cycle in other economies. A country may have a lot of foreign investment because of which its output is at a higher level. Because of some unexpected international developments there could be a capital flight, that is foreign capital is withdrawn from the market. The net exports function. Net exports means export minus imports. Thus, the value of net export depends upon the values of exports and imports. Exports lead to expansion of at market. Thus, aggregate demand increases when exports increases. Therefore, it is an objective of most countries to promote their exports. How much a country can export is not in the control of the exporting country. Export of India depends upon the GDP level of its trading partners. If the US has good grown prospectus, it may import more from India. Thus, assume export to be exogenously determined. It it can be that experts do not depend on the output. It means that experts do not depend on the output level of the domestic economy. The behavior of imports, however, is different. As output level increases in the country, there are requirements of more imports. Demand for imported raw materials and foreign technology increases as GDP level of a country increases. That means the export export is determined. Exports do not depend on the output level of the domestic economy. The behavior of imports is different as output level increases in the country. There are requirements of more imports, so that the import of the country is important for the export. Therefore, we will assume that imports are proportional to output. That means M equal to small m into Y. When we subtracted M from X or import from export, we find that Nx is a negative or inverse function of output. When Y is low, Nx will be positive because X is greater than M or export is greater than import. When Y is high, output is high, that means net export will be negative because import is greater than export. There is another factor that determines exports and imports, that is the exchange rate. As the value of domestic currency decreases, domestic goods become cheaper in terms of foreign currency. So, depreciation of Indian currency will have an effect on Indian imports also. Depreciation means valuation of currency. If when it is falling down, the currency's value is fall. That means depreciation happen. That means it can be cheaper, and the value of money is cheaper compared to other countries. That affect our imports also. We know that Indian goods become cheaper due to depreciation. If we see it from other side, foreign goods become costlier because of depression of Indian rupee. Thus, we observe that due to depreciation of Indian rupee, Indian export increases and Indian import decreases. As a result, NX increases when Indian currency depreciates. We should note that net export depends upon domestic output and exchange rate. As domestic output increases, there is a decline in net export. Further, depreciation of domestic currency leads to a decrease in net export. Appreciation means an increase in the value of domestic currency in terms of foreign currency. Depreciation and means in means decrease in the value of domestic currency, and appreciation means an increase in the value of domestic currency, and depreciation create because of depreciation domestic goods become cheaper in terms of foreign currency, and so that imports is less than the exports. Then equilibrium output in an economy. Thus, there is an increase in aggregate demand when external sector is present. In the three sector model that we discuss, AD equal to aggregate demand equal to C plus I plus G, consumption plus investment plus government expenditure. In the four sector model, the aggregate demand curve takes AD equal to C plus I plus G plus X minus M. That means consumption plus investment plus government expenditure plus net export. We describe the AD curve with the help of a diagram. In the figure, we have shown the C plus I plus G curve means curve, three sector model curve. We have added NX to it so that there is shift in the AD curve. We should notice that it is not a parallel shift. It is because the NX curve is downward sloping. Thus the gap between C plus I plus G and C plus I plus G plus NX narrows down with increase in output. When there is no external sector, the equilibrium output has Y1. However, when the economy opens up, there is an increase in equilibrium output from Y1 to Y2. And in this case, it's in the when external sector is present, that time the model is known as four sector model. And here the output is more than the three sector model far. Then this is the equilibrium point derived. First initial equilibrium is E1. Then the new equilibrium point was derived, that is E2, which is more than the initial equilibrium point. When government sector is present, that time the output also not more than the external sectors present. The equilibrium point E1 is derived through the the 45-degree line AD line, and when intersect the CIG AD curve. CIG curve, and the next equilibrium also derived through this way. This from this thing we now got the equilibrium output in an open economy, which is much more than the three sector model. So, Keynes also first Keynes described the closed economy where only two sectors present, farms and household. Another, he extend its economy, and then government is added on his model, and they are three sector model, and government spending is also plays important role in the economy, and it can be increase the country's progress, and some welfare work also done by the government sector, and government imposes and taxes which is and for that the output also equilibrium point is also increase through by this on this three sector model. And in external trade, when trade is possible, when we trade is going on or import export is possible, then time there is four sector model. The economy is open up, and there are four sector model. And in four sector model, you discuss about that is open economy and GDP, GNP. Now GNP is nothing but GDP plus NFIA, net factor income from abroad. And balance of trade also coming here, and in this balance of trade, we find exports and imports. When export is more than import, that is surplus trade, and when import is more than export, that is deficit trade. Then some invisible items are shown, which are important determination of balance of payment. Then balance of payment is derived from current account and capital account. When current account and capital um, account are added together, we find the balance of payment. A balance of payment means that is the country's overall country's growth, or balance of payment always balance. Overall balance of payment balance is obtained by adding the current and capital account balances. And balance of payment sometimes is surplus and sometimes it is deficit in nature. Then net exports function, which is also important factor, and it is net export function depends upon domestic output and exchange rate. Mainly, then exchange rate is the appreciation and depreciation. Depreciation, which is very important, which in decrease the value of the value of the currency, domestic currency, which can encourage exports but discourage imports. And equilibrium output in an economy also derived like, and which is more output, which is increased point of than the three sector model. So now we complete this total Keynesian model, and classical model also finished in the previous classes. Here, any doubt? Hmm? Okay then, bye. Next class, tomorrow, 15, we come to another chapter. Thank you.